Good afternoon, everybody. We appreciate you joining us today to hear the story of Bonaventure, a story that drew me here a year ago to join Bonaventure. My name is David Pittman. I am the head of capital markets here at Bonaventure and look forward to, like I said, sharing our story with you. We've got a 25-year history that has been built in the multifamily investment space. And today we'll be joined by Dwight Dunton, our CEO, to tell that story.
Thanks, David. Excited to be here with you and share the last 25 years of helping families build long-term wealth through investing in multifamily real estate.
Awesome. Awesome. Well, the agenda today for the next 30 minutes, we'll try to keep the presentation 25, 30 minutes at the most, and then leave time for some Q&A. We'll like I said, we'll talk through that story of Bonaventure, how we got here, how, what Dwight did over the last 25 years to get us to $2.7 billion in assets and serving all the families we've served over that time. We'll talk about how we manage risk and, create durable value in multifamily real estate space. And then, more importantly, we'll talk about how advisors and their investors can access Bonaventure through different investment strategies, structures, etc. And, as I mentioned at the beginning, my name's David Pittman. I'm head of capital markets. I've been serving the independent broker-dealer and RIA community, representing different alternative investment sponsors over the last 24 years. And excited to, like I said, excited to be here. When I heard the Bonaventure story a little over a year ago, it made it very easy for me to decide to, come over and help build out and build the relationships with financial advisors in the wealth management channel. And with that said, Dwight, I will hand it over to you to share your story and what we're looking at doing into the future as well.
Sure. Well, glad to be here with you, David. Let's get rolling here into the meat of the presentation. So 25 years ago, we started with a single apartment building that our family had owned a piece of for the previous 40 years, and it had done everything one would hope that multifamily investment can do for your investment portfolio: produce cash flow. It appreciated in value as an inflation hedge. And every decade or so, the property was refinanced and we got a chunk of capital back. And that was really the legacy we had when Bonaventure started. And we've spent the last 25 years just continuing to do that same thing. And today, I'm kind of surprised and shocked to look back 25 years and go, wow, we've almost become $3 billion of assets. We've got the largest amount of capital between the principals of the firm and my family invested. We've invested with over 500 families that we've helped to grow, and we've been super successful. Like, our returns, I think, speak for themselves with their, almost the 25 IRR and almost the 3x equity multiple. And so it's super exciting. So I'm going to talk to you about how we do it, our lens, because ultimately that's what matters is our systematic approach. So, I think the first thing is I decided a long time ago that I just didn't think that making money in Excel was a very viable plan. I mean, everybody's pitching you business plans, and in Excel, everything makes money, but no deal survives contact with reality, no matter how much you plan. And so it's really important for our family to make sure that the key pieces required to take a business plan and battle the future was to have the capabilities to get that done. And so we built a development company. We built a property management firm called Vest Residential. I happen to be wearing our vest today. And our latest company is Internet Subway, which provides internet services at our buildings and for other building owners. And the question is why do we do this? It's not because I necessarily want to be in any of these businesses, but what we discovered is we couldn't find anyone that did it to the standard or had the level of commitment to ensure that we got the outcomes no matter the curveballs that the future handed us. And I think that's what distinguishes us is we've invested in these platforms so that there's hundreds of people across the Bonaventure companies that are committed to making sure we get the outcomes no matter whether it's COVID or the great financial crisis or rapidly rising inflation after COVID. Our teams of people are working hard to get the outcomes, even though we didn't see all of those things coming. And so what is it that ties all this together? Well, it's multifamily. It's our integrated approach. it's not just making sure we make money, but it's making sure that we keep as much of it on an after-tax basis. And it's about ensuring that we survive the downturns because the economy cycles, and we need to be able to go through whatever trough. And a lot of that comes from our perspective on fixed rate debt. I remember when I started the company, it seemed like a very simple decision, which was, remember watching Alan Greenspan drone on in front of Congress about the future direction of interest rates. And I left the CNBC channel when he was speaking more confused than I started. And I said, if he doesn't know what he's talking about, neither can we. And so we just made the decision to be fixed. And I would say that's singularly the thing that has helped us come through all of these market cycles unscathed, starting with the dot-com bubble, the housing meltdown, COVID, et cetera, was we had fixed rate debt, and that allowed us to focus on just executing our business.
And I think that's so critical, having that philosophy of, long-term tax efficient compounding that really is the way that, real estate investors should be thinking about real estate and what's created generational wealth for people. It for me, it only makes sense to match up the debt with that philosophy, right?
Yeah.
Being long term.
Yeah, I mean, I think, as we'll talk about here on this slide, generally speaking, the multifamily market moves up and to the right over a long period of time. And the way that people really get wiped out in that is they have to roll a loan during one of those downturns, whether it's a downturn because of general economic conditions or overbuilding or something happening in a particular submarket like a military base closing. They get wiped out because they had to roll that loan during a time of illiquidity or a lower NOI, and they ended up having to sell the property to somebody else who then wrote up the value creation. And so that's where that long-term fixed rate debt comes. But when you overlay that against the housing dynamics in our country, it is our perspective is fundamentally broken, that the ability to produce housing in the places that people want to live is throttled because the people that are already living there say no. And so that creates this regulatory barrier where housing supply and demand can't be adjusted the way that any other product can be. You can build another factory to supply a product if you have a lot of demand. You can't do that with housing. And so if you just accept that structurally housing is broken in our country, now we want to look for places where there's population growth, where there's strong ability to say renting is cheaper than buying. We see that the average age of the renters is rising as affordability of for sale housing continues to be out of reach of more and more people. And currently we're seeing that the construction pipeline is collapsing from a generational high to probably a generational low. And that's the backdrop in which we make all our decisions. And so the question is, what do we do with that? Well, we look across these markets, which is generally the Southeast, and we find those supply constrained markets. So even though there was a lot of large MSAs that had a lot of product delivered, there was a lot of places where there wasn't. And even though they had positive rental growth, even though there was a lot of opportunity between older properties and newer properties to raise rents, there weren't property or new units delivered there. And that makes for the ability to drive long-term returns when we find that combination in a submarket or market. And you might ask, what are some of those submarkets? It's Charlottesville, Virginia. It is Greensboro, North Carolina, which I contrast to say Charlotte, North Carolina, where South End has had amazing population growth, which has only been overcome by more amazing supply growth. And so it's a terrible rental market. And so those are the markets that we look at, and there's a lot of opportunity, more now than there has been in the last several years. And so you've got this kind of structural backdrop of housing dynamics. We look for these submarkets that have these favorable conditions, but more importantly, it's about building the resilient capital stack. And so, we became one of the largest borrowers for HUD. And for those of you that don't know about HUD, it's the worst process and the greatest outcome. And by that, I mean, it takes months to get the loan, but the end of the day, you have a loan that lasts either 35 or 40 years, fully amortizing. And as you see here, we have loans that are in the twos that we will fully pay off. It's a great outcome, and that provides that stability and ballast. So when rates were at COVID lows, we said, let's lock that in for the next generation. While some other investors and sponsors said, you know what, let's roll the dice on staying floating. And unfortunately for those folks, the Fed raised rates exponentially, and now what seemed like a sound investment decision was destroyed by a bad decision on the capital stack. And so when we find those assets, what is really important is to get that alignment with our investors. And again, these are all families, these are individuals, people who are building for their future, whatever that future entails. And so we understand that it's not a one size fits all. I think a lot of people understand and just intuitively grasp housing because everybody needs a place to live, but people's investment horizons, whether they want to have a commingled fund, whether they want to own a single property, whether they're coming at it with tax advantage capital, we offer ability to participate with us through all of those different ways for those individual investors. So if you're looking for a fund where you've got a lot of diversification, growth, and stability, we offer BMIT, which is our multifamily net asset value REIT. We have a common share, which is a combination of income and growth, and we've got our preferred class, which is all about the income side of things. If you have tax advantage capital because you've owned some real estate and it's appreciated, we can help you through our 1031 exchange, 721, and DST solutions. And for others who have high conviction investing and they want to know the asset and say, yes, I love that investment thesis and I'm all in, you can invest with us in single properties. And so these are the kind of two strategies within BMIT, but high level BMIT is, think of it as a mutual fund of apartments in the Southeast. It's about 23 properties, $1.2 billion of asset value. And Bonaventure is the largest investor. We've got $133 million of capital. So we are highly aligned to the long-term success with our investors. And so our common shares, you can buy them each month, and you can participate in quarterly redemption after your initial 1-year holding period. And this is right for investors who appreciate a combination of income and growth. They like the fact that their returns are largely tax sheltered. They can use the dividend reinvestment to continue to compound by acquiring more shares. And they sleep well at night knowing that we are watching our money along with our investors' money because of our high alignment of co-ownership.
And just as a reminder, I mean, the common offering, give a little history on what drove us to create BMIT in 2021.
Yeah.
And then how that kind of carried over also into our continued, growth around the, operating partnership type of ownership, UPREITs.
Sure. Yeah. So, one of the hallmarks about Bonaventure is we're always solving complex problems. And so in 2020, we had developed problems that stemmed from amazing success, which was we had investors who invested with us for a long period of time. They had continued to roll their investments with us through 1031 exchanges. And after 10 or 15 years, their life had evolved and they wanted to get some of their treasure so that they could pursue their dreams. And we didn't have a convenient mechanism to allow one investor to sell one piece of a property. And at the same time, we recognized that as many families as we had helped, there were thousands more that we would never meet. And so that challenge and opportunity came together as BMIT, where we rolled together a number of properties that we controlled so that those investors went from owning a piece of individual properties to now owning shares in the fund. And then the fund could offer investments to new investors that through their financial advisors to continue to help more and more families. And those two things coming together was an elegant solution to help our current investors when they wanted to get more liquidity, but also help new investors so that they could say, I'm ready to invest with Bonaventure this month. And we had a convenient way of helping them.
And in the NAV perpetual structure just was, I would say, was the best package in terms of being in alignment with, once again, the way you think about investing, right?
Yeah,
It's tax efficient, long-term compounding. Let's avoid erosion of capital by paying taxes and cycling to new programs.
right. And the other thing that for me is like just it gets me to come to work every day, it gets me excited to talk to investors and prospective investors is like it's all about helping them meet their long-term goals and to now disconnect the decision of when to sell a property because it's reached full value versus a family's decision on when to sell their investment because they need to use that capital for something else. That was really powerful for me because it allowed us to be great real estate investors, but then allowed our investors to then make decisions that are best for them, irrespective of when we were deciding to sell this property and redeploy into a property that had greater growth potentials.
Yeah. Awesome.
And the preferred is just a different version. It has a higher cash flow. It does not fluctuate in value. And it's for those investors who love everything we do, but they're very focused on current income.
Yeah. And and also, when I got here, end of last year, and we're still seeing it today. There just wasn't as much capital chasing the equity of real estate because of the macro environment that we all experience when you look at multifamily or real estate in general, right? With expanding cap rates, rent growth, and a lot of the markets that were oversupplied starting to, taper or even flatten and in some cases go negative. There was just a lot of uncertainty where valuations were going, and it was hard to attract, capital into the equity side, common equity side of a lot of real estate programs. And I'm sure a lot of you on this call have experienced that and seen that. And so the preferred, what that did is said, let's give people a pathway to diversify their source of returns into real estate, but at a more conservative entry point where you were removing that valuation risk, right? Let's get you an 8% distribution, which is kind of on the bottom end of our total return expectation on the common. Let us get money in the door where we can, out of 4,200 doors in BMIT, we've got 1,000. We can go put, $5,000 to $20,000 into, each door, get 15-20% returns. It made sense from us as a cost of capital. But once again, it gave people a conservative entry point to get to know Bonaventure as well. And so with that preferred, there is no forced conversion like some other preferreds that are out there. It's basically got a 6-year declining, charge to get out, starting at 10% down to 0 at year 6. And however, at the 4-year anniversary of the fund, we can do an early call for cash, but we cannot convert them. However, at the investor's decision at their 4-year anniversary from their investment date, they could choose to convert into the common at a 5% discount. So they've experienced, had a positive experience with Bonaventure, with BMIT. They see what's going on with the common. They're seeing the markets turn back around. They can come in now into the common at that 5% discount and participate on the growth side as well.
Perfect. Let's keep motoring. And so one of the things we discovered was we formed BMIT through doing what's called an UPREIT transaction or 721. That's where you smush properties and merge them together and everybody gets back shares in the resulting partnership. Well, what we discovered was there were lots of other sponsors that had similar challenges. And so we've been able to acquire their properties through these 721s, and it was great for both parties. They got the benefits of diversification and tax deferral, and our investors got access to assets that weren't on the market for sale and at values that were slightly below what the market would have paid for. And so it's been a great tool for growing the portfolio and driving returns. And so these are examples of some of the things within BMIT, but also examples of what Bonaventure does throughout the economic cycle is sometimes it's great to buy core assets that are levered to rent growth. Other times it's slightly older assets, but have a little bit of repositioning. And then sometimes it's assets that have a lot of opportunity to deploy capital where we can get really attractive returns, especially at times when there's not a lot of construction going on, but you have increasing demand for newer stuff. We can deliver that in 3 weeks by taking an older apartment and refurbishing it and get great returns on invested capital. So you get all that in BMIT, but also through our other investment vehicles. So I think this just kind of lays out the benefits of each of these approaches. And, you can see, again, different strokes for different folks. And we really try to be user-friendly in order to bring our expertise to as many folks as possible and give people flexibility to choose things that are best for their investment portfolio and their future.
Yeah. And as far as, how you can transact with Bonaventure, just on the common. So, like the common, we don't even have a commissionable share class on the common. It's advisory only. However, on the preferred, there is a commission structure for that one, and those commissions are covered by, covered as a cost of capital by the REIT, and so they wouldn't experience the drop in value. If someone invests 50,000, they see 50,000, they're getting 8% on that 50,000, and that any kind of commissions fees are covered as a cost of capital. And so, we definitely have a well diversified, portfolio of options for folks depending on their needs. With that said, let's open it up for some questions.
Yep. So we've got a few in the chat window. First question's about long-term alignment. And wow, how's the team compensated and how much capital we have invested alongside our program? So great question. We are the largest investors in all of our programs. So I think first and foremost, we think of ourselves as co-investors rather than sponsors. So I think that's first step of alignment. Secondly, when we do succeed, we get paid an incentive compensation fee, differs by program, and then we share that across a large swath of our employees. So they are motivated to help drive long-term performance. And we want to share that with them to keep as many people engaged and focused on the thing that's most important to our investors, which is driving excess returns.
Awesome. And I think an important point there too is, over the life of BMIT, all of our asset management fees, our, promote, anything we've received in terms of promote, we've taken those fees as shares. And wasn't even until last year, Dwight, that we even took some distributions out off of those shares,
Yeah.
those fees.
Yeah. We've
So
been
very much
increasing our
aligned
investment.
with the investors.
Yeah. We've significantly increased our investment since BMIT started. What else do we have here, David?
Let's look at I look at question three there, walking through, how we've performed across the different cycles, because I mean, I think that's an important question just because we're kind of coming to the tail end of one cycle and starting the new cycle. We've heard Casey,
Yeah.
our portfolio manager, talk about we're kind of in the second or third ending of, kind of in terms of, re-entering back into kind of purchasing and acquisitions and back into the market.
Yeah. I think we've performed really well across many cycles, and this isn't just talking about the most recent one, but what we have done is that fixed rate debt allows us to get through every trough. So even if a property experiences a reduction of NOI or the lending environment is not favorable, we've been able to get through that. So I think that's one factor that's really helped. The second is really the asset selection and submarket selection, where we picked durable assets that have not really been hit by softening economics for whatever drove that, whether it was a collapse of the housing market or the popping of the internet bubble or everybody being told to stay home and not go to work. Those things helped us because we had great assets that all bounced back after those situations ended.
Awesome. Awesome. I mean, that was one thing that attracted me to Bonaventure as well, is just when, there's a lot of multifamily sponsors out there. and a lot of them were just dependent on what's riding those macro tailwinds. You needed cap rates to compress, you need rent growth, to justify those investments. And many folks in 22 and 23 were simply saying survive till 25, right? And those folks were just basically, selling in a boat with just a sail. And because of, the value add stuff we do, the internet, starting the internet subway, we had a backup motor on our boat that helped us, keep pushing us forward, right? So,
Yep, a great. I totally agree. We got another investor, a comment from another investor about he's an investor in Messenger Place, which is a DST that we launched earlier this year, and he's going to roll into BMIT, and he wants to know what's coming 2026 and how do we expect things to play out in the future. I expect the future to be exciting and uncertain, as every year is. However, I do think that some of the macro environment has shifted from headwinds to tailwinds about delivery of units, interest rates staying higher for longer, locking more people out of the housing market, and that the economy is generally doing really well. The economic growth versus sentiment are not calibrated, but largely people still have jobs. We're still close to record employment levels. All of those things are really good long-term predictors of a stable and growing rental market. Obviously, real estate is all about location, location, and location. And so as long as we're making good submarket selections, I think there's great real estate fundamentals. And on top of that, I think there's going to be great investment opportunities. Because if you think about it, in 2021 and 22, folks were buying assets at 3 caps and 4 caps, and those assets are underwater. Those sponsors are going to need to sell those assets next year or the following year. And I think there's going to be a lot of really good assets coming to market at much lower basis than the last guy. And I think that's going to be a great opportunity for us and our investors to buy some tremendous assets at way below the cost to build or the last what the last person paid for it. And that's going to be against a really good fundamentals for apartment markets.
it's awesome.
Yep. I think we have time for one more question here before the end. You see one, David?
Um, there was a question about, where, in terms of positioning, as an advisor, where do you position or how do you position this in an investment portfolio, BMIT common versus BMIT preferred? Really what I'm looking at, as I'm talking to advisors, I'm talking to firms out there, the darling of the private markets lately has been private credit. We're starting to have conversations where, you're kind of getting late in the cycle there. So there could be opportunity to, come back into a more favorable, part of the cycle with real estate and maybe taking some of the house's money off the table from some private credit or other areas of your alternative investment allocation. It could also be a great place, where, if you want to start taking some of the house's money off the table in the equity part of your portfolio, where you're, historically seeing, 10% annualized returns. If we can, generate, 8 to 12% annualized returns over time without that correlation to the market, it's a great place. Within the equity part of the portfolio, it's a great place. We're starting to see, pressure on interest rates, I believe that the sentiment in general around interest rates is we're going to start seeing them go down. And obviously people are going to see some reinvestment risk on the fixed income part of their portfolio. So the preferred is a great, is well positioned to help manage that reinvestment risk, push out some duration in your portfolio, and know that you're locking in a good 8%, fixed rate of return over time.
Yep.
You know, so
Those are
uh,
good points, David. Thank you.
yeah. No, I think that's it. That's all of our questions. Dwight, great job. Really appreciate you, taking the time to share the story, share your story with the group. Any departing words or thoughts that you'd like to
All
share?
right. Thanks for being my wingman here today. And more importantly, thank you to all of the folks who tuned in today. There's a lot of you out there that are wanting to learn more about Bonaventure. That means a lot to me personally, that taking your time to learn more about what we do. If you have follow-up questions, reach out to us. I love spending my time with our investors and their reps and helping folks plan for their future. So if you
Awesome.
happen to be working with Bonaventure, that's a bonus, but we just want to help.
Yeah. And feel free to reach out to me directly. And, if I'm not the right person to connect with, we'll get you in front of the right people. So we appreciate the time, everybody, and thank you again for joining us and look forward to connecting with everybody.
Thanks. Have a great day.